Hello and welcome. My name's Andy Crook. I'm your host for tonight's training on the subject of cash flow modelling. Every week I go live on a training topic in one of the 5 pillars of business as I see it to try and help garage owners become more successful in business. Tonight's training topic is in the financial pillar, and it's the third in a series of Know Your Business, Know Your Numbers that I've been doing over a period of time. And tonight we're going to look at cash flow forecasting or modelling your business as a way of predicting how much money will flow in and out of your business over a set period. Now, the cash flow forecast isn't to be confused with the cash flow statement. The cash flow statement focuses on past cash flows, while the cash flow forecast aims to predict what cash will flow in and out of your business in the future. I've said on these training topics many times that when you're dealing with financial statements and you're an accountant, you're often dealing with things that have already happened. And that's great, and it provides you with information that you can use to try and predict what's going to happen in the future, which is what a cash flow forecast is. And cash flow forecasting improves your financial intelligence. All of these in the series of Know Your Numbers, Know Your Business will improve your financial intelligence. But what do I mean by that? Well, there are 2 meanings of intelligence when it comes to this. And in its broadest sense, I suppose intelligence refers to the ability to learn, understand, and apply knowledge and skills to make reasoned judgments and adapt to new situations. But intelligence is also the collection, analysis, and use of information to understand and predict the capabilities, intentions, and activities of businesses and the business environment. So, financial intelligence, in this sense, is understanding the numbers so that we can apply knowledge and skills and make reasoned judgments and adapt to potentially new situations. But it's also the collection, analysis, and use of information to predict activities within the business. So intelligence is both meanings when we use cash flow forecasting. So why is the cash flow forecast important? Well, the cash flow forecast is a projection. It's a prediction, and it tells you how much money is expected to move in and out of your business during a specific period. And you can adjust the period of your cash flow projections to see how your finances will change over the courses of a week, a month, or even a year. When you know your projected cash flow, it's easier to plan for potential gaps or dips in your income. So that's why a cash flow forecast is important. It's so that we can plan ahead for potential gaps or dips in income for your business. Now, when it comes to putting your cash flow forecast together, what you need to understand is the length of time you're going to project forward. And the longer that period of time, the less sort of accurate the cash flow forecast will be. And it's something that you should review monthly, certainly quarterly, and most people have a cash flow forecast that goes out to around about a year. And it's only accurate if you revisit it and adjust it monthly and quarterly. Otherwise, what we're trying to do is predict cash flows that are just too far in advance. So that's the first thing. We can use it, especially if we're refining it all the time, to predict for potential gaps and dips in our income. So what are the benefits of a cash flow forecast? Well, the first thing I'd say is forecasting is a great financial habit to get into. And it has multiple benefits, including spotting cash shortages and giving you time to work on contingency plans. Whether that's delaying your spending, requesting extra credit from suppliers, or even securing a business loan. It also allows you to assess the affordability of your growth plans. So one example that I like to use and the cash flow forecast is very good for, is to show if there's going to be enough money to invest in new equipment and tooling, or even to hire a new employee. You can do it on paper before you actually do it for real, and you can have a look at, and you can try and predict how that investment, if it's in equipment or tooling, is going to affect the business. Is it going to have a positive income or a negative income? And it's also true as if you're going to take on a member of staff. So you could look at how taking on a member of staff may impact the business. Remember that you could probably look at previous occasions when you've done this, if you have the data, to see if at all, was there any positive or negative impact to that taking on a member of staff. So that what is another a benefit of the cash flow curve is you can identify quickly if expenses are increasing or income is reducing for whatever reason. And it could be unexpected increases in expenses. And we all know how that feels with the recent sudden rise in energy costs, for example, gas prices, electricity. And we could see suddenly how our expenses had increased and the impact that had on our cash flows. And highlighting fixable cash flow problems such as slow paying customers, impractical payment terms, seasonal cycles, or over-reliance on high-cost finance. We can use the cash flow forecast for all of these things. So let's say we've identified we're going to have shall we say, a sticky patch coming forward, and we've gone to get a loan, or we're going to use the credit card to bridge that period of time, and we can see that credit card payment is going to be very, very expensive if we don't pay it back within time, whereas the business loan may be a better option. So it's that comparison, if you like. We can run the outcomes without actually doing the physical getting a loan or spending it on a credit card first, to see what that impact that will have. And they're the benefits of the cash flow forecast. What you can do is you can see the outcome or the potential outcome on paper before you go ahead and do anything within your business. And the better the model, the better the forecasting, the better the outcomes, and therefore the better the decisions you'll be able to make. So what are the key components of a cash flow forecast, and how does it differ to other financial statements? Well, I suppose the first really big difference is we are predicting the future, whereas other financial statements really are living in the past. So what do we need on our cash flow forecast? Well, we need to know the starting position the business is. So often this is cash in the bank. And then what we're going to predict next is the expected cash that flows into the business, mostly from sales, but it could be from loans or sales of assets if you need to, and we can predict that income into the business. And then we're going to look at the expected cash out, our normal expenses, or any planned non-normal expenses. So cash that we know is going to be leaving the business at certain times, added to our normal expenses. And then what we can look at then is the net cash flow, which shows us if cash reserves are going to grow or they're going to shrink during this period, and it's going to provide us with a closing balance. Remember, we're doing this probably monthly, quarterly, and annually once we get into the hang of it. So you can see that the key components really of the cash flow forecast is knowing how much money we had at the start, the amount of money that's going to flow in, the amount of money that's going to flow out, and then whether or not our cash reserves have grown or shrunk in that period, which is displayed by our closing balance. And if our closing balance is greater than the starting balance, we're growing. If the closing balance is less than, we're shrinking. It's as simple as that. So how do we do it? Well, we need to build a model. And I'm going to do another training topic on model building over the next sort of 12 months or so. It's in the plan. We're going to look at business model in a lot more detail. But basically, what we need is some form of spreadsheet. And it could be Excel, Google Sheets, whatever it is, we need a spreadsheet. And then we're going to use those key components. So we're going to have the sort of the first row, if you like, of the spreadsheet is the starting position, the cash we started with. And the final row is going to be the closing balance. And what we're going to do is we're going to estimate the cash in that period of time. So what we can do is we can look at our previous business performance, and we can look at the various months of the year, and we can look at other data and other information that's out there to help us. And we're going to predict how many jobs we're going to do. We're going to predict the different sales within the business. Now, you can just do it as a basic model where we say, well, normally we have, let's just use some round numbers. We normally have £10,000 worth of cash into the business in a month, and that's what we're going to predict for this month. And we normally have a slightly better month in, should we just say, April, and we have a slightly worse month in December. But the rest of them are fairly average. And that's how we're going to estimate our cash in. If we're being a little bit more specific and we're building our model up to be more detailed, and like I say, we're going to do another training topic on this later in the year, we start to break down the cash in from different, if you like, parts of the business. So it could be the number of MOTs we do. It could be the number of services. It could be the number of repairs. Could be the number of diags. Whatever it is your business does, and you can bring it. You can look at those as individual line items on how the cash comes into the business. And once we know what the cash flowing into the business should be, remember, if we're going to be selling any assets, or if there are any loans coming in, or we're planning to do that, we can feed that into the cash flow forecast in the month that it will happen. And then we're going to predict the cash out. And this is often based on our previous expenses. And we might know that, for example, in February, we pay our insurance. And therefore, in February, we have a lot of money goes out in one go. That's if we don't spread the cost of it, obviously. But it could be that we know that happens then, and we can account for it. So you can see how you can predict the cash out of the business based on previous performance of the business. And this is where the profit and loss statement can help you, because it itemizes these things. If you spread that, if you do separate how that business is, or that cash is accounted for in your business, in your expenses part of your profit and loss sheet, you can just simply transfer those into your cash flow forecast. And then you can look at it month on month and see when there is larger amounts of cash going in and larger amounts of cash going out. And then we can look at how that affects cash flow, the ebb and flow of cash through your business over the month, the quarter, or even the year. And you can see how various shall we say, activities within the business and various bills that we have to pay and how we pay them impacts on cash flow. And it might make you decide that, you know what, spreading the cost of that insurance may be worth the premium that we pay, in terms of we might pay an extra 10% to spread the cost, because it levels out cash flow within the business. It might be worth paying that. Or you might say, you know what, we know it happens in this month, and for us it's February. What we'll do is we'll save up enough money and we'll pay it all in one go, and we'll save that 10%. It's totally down to you and how you run your business. So cash flow forecast is basically a model of your business based on previous performance and information that you have about the future and how it's going to go. And this is where we can do very, very simple things. Like, so we just said, we know based on what happens in the business, how many hours labor is sold per technician. So if you were to take on another technician, you could say, right, we're probably going to sell that many hours more labor because we've got another technician. Bear in mind, if you're turning work away, or you can't quite deliver on your AC/DC, we need another technician. Can we afford one? What will that do to the business? Remember that at the end of the month, you have to pay that technician, and you have to pay the various bits that go with that, like national insurance and the tax. income tax and the business element of all of that. And you can then add that, because you know how much it is for one technician, you can add that to your forecast, and you can see how many more hours you would need to do to employ someone. You would know how much more income you would need to generate, and you can see how this builds up. And you can say, right, even if we take someone on, and generally what happens when you take someone on is a slight, you might have a honeymoon period where everything goes really well and you get more hours than normal, but normally what happens is you actually reduce your efficiency, because that person's new, he doesn't know where everything is, it takes a while to settle in, and then there's a kind of relaxation within the team because there's another pair of hands, and maybe things aren't quite so urgent. You know, you can look at previous performance and see if that's true in your business, but you can look at that then and see how that person coming in, how that affects the business, and whether or not you can afford to do it. Or you could do it, as I said before, if you're investing in equipment or tooling. Will it necessarily, earn more money? Will it allow you to do more tasks? Sometimes it isn't. You're replacing existing stuff as it wears out, and you have to allow for it. But that's what the cash flow forecast allows you to do. It allows you to put that spend into your forecast and see how it'll affect the business. So what's the atomic action for this week? If you don't have a basic model for your business, that's the atomic action. Have a basic model with the key components in it: starting position, expected cash in, expected cash out, that measures the net cash flow. Are you, by looking at the closing balance, are you increasing cash reserves, or are your cash flows reserves shrinking when you do the modeling? If you've already got a basic model, start adding some detail. Cash flow forecasting improves your financial intelligence. It's a good way to learn and understand how cash moves around inside your business and get a better understanding of it. It's well worth the time it takes to do, and it's well worth developing a better and better model as time goes on. If I've made you think about how cash flows in and out of your business today, then I've done my job. If you're thinking about doing a cash flow forecast, have a look online. There's a couple of online free templates that you can use. If you're really stuck and you need one, I've got one that you can use. And then I know there are other people out there that create these for you. So just send me a message and I'll happily send you mine. Thanks for listening. Take care.